Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Tariff tensions test investors. Markets start the week in risk-off mood as China and the US accuse each other of violating last month's trade deal. Polarized Poland, a nationalist candidate backed by Donald Trump wins the Polish presidency with a margin of less than 2%. He vows to act as a check on Donald Tusk's pro-EU government. Plus, Ukraine stages a dramatic series of drone strikes across Russia, hitting targets as far away as Siberia. This ahead of crucial peace talks set to resume today. Good morning, happy Monday. So trade tensions and geopolitics back in focus for these markets then. It is risk off across the equity session. We see the pressure over in Asia. European futures pointing lower as well by 0.2%. This spat between the US and China over that trade detente of last month. President Trump still holding out hope that maybe he gets a phone call with his US-Chinese counterpart later this week. We'll see, though, if that comes to anything. FTSE 100 futures here in the UK pointing lower by about 0.1%. S&P futures also softer by 0.5 on these trade tensions. Nasdaq 100 futures pointing lower by 137 points, down 0.6%. Let's flip the board and have a look cross-asset. We've been listening as well to the Fed's Chris Waller speaking over the weekend, suggesting that rate cuts towards the back end of the year are still a possibility. The US 10-year at 4.42, yields just up currently at 2 basis points on the benchmark. Euro dollar at 1.13. We focus again on the dollar. 5 straight months of losses through into May, and Morgan Stanley suggesting that further weakness is there, possibly as much as 9% in terms of the downside for the greenback into next year. Euro dollar then at 1.13. The single currency getting a bit of a lift on softer dollar again, up 0.2%. Brent in focus. Interestingly, oil is rallying up $64 a barrel right now, up 2.4%. Some investors expecting that more oil would have been put on the market in July on the back of that decision from OPEC Plus. 411,000 barrels per day is what is being agreed to. In terms of gold, that is getting a lift in terms of the haven move into the yellow metal at 3,316, up 0.8%. We'll briefly check in on the Asian markets again. The biggest drop across Asia we've seen in about a week, again tied to that trade tension, of course, with the focus on US, China. MSCI Asia Pacific, that benchmark down 0.8%. Over in Hong Kong, the HSI dropping 2%. The Nikkei in Japan also a little weaker by 1.3%, and the yen currently up 0.3% versus the dollar at 143.53. China then accusing the US of violating their recent trade deal, promising to take measures to defend its interests. That is dimming the immediate prospect of a leadership call that President Trump is seeking, as I mentioned. But US Treasury Secretary Scott Bessent, well, he remains optimistic.
I have a prediction on how much it's going to impact the steel industry, and we'll see. There are a lot of elasticities that this is a very complicated ecosystem. So, is it going to impact the construction industry? Maybe, but it's going to impact the steel industry in a great way.
OK, let's bring in our China correspondent, Min Lo. We heard from Scott Bessent there, of course, the US Treasury Secretary, also talking, of course, President Trump about potentially additional tariffs on steel and aluminium. That is another factor in terms of the trade tensions. Min, talk to us about what the likelihood is of a call between the two leaders of the US and China this week, given the barbs that have been traded by both sides in recent days.
Yeah, Kevin Hassett, the U.S. White House economic advisor, had said that this call could happen as soon as this week. But from the Chinese side, we haven't heard any official confirmation, although granted, when it comes to China's communication of these high-level calls, oftentimes it can be very last minute, sometimes as late as the day before. So it's hard to tell. But bear in mind, President Trump had previously also said he was expecting to speak with President Xi at the end of the week. That was the week after the two sides had met in Geneva for the trade talks. But that call call hasn't happened. So how much weight can we put behind Kevin Hassett's words? I think that is still a big question mark at this point. But as you said, the two sides have been trading barbs, and the latest this morning from the Chinese Commerce Ministry is that it is accusing the U.S. of violating the Geneva Agreement with a series of what it's calling unilateral discriminatory acts against China, including, number one, revoking those Chinese student visas, and number two, expanding the chip curbs. Remember, there was the banning of the H20 chips, and over the weekend, we understand the U.S. is looking into expanding chip curbs to the subsidiaries of companies that are already sanctioned, and also limiting the sale of these chip design software to China. So China is saying U.S. is the one that is stirring up these trade frictions, while U.S. is saying the same thing of China, especially when it comes to being slow in rolling back some of these countermeasures against the U.S., and in particular when it comes to the flow of critical minerals into the U.S. So Trump is saying he's confident that he'll be having a call soon, that he will be able to clear all of these up in a phone call. But given that souring sentiment, it's hard to say whether presidency will be willing to pick up the phone call. Bear in mind as well, there was a Shangri-La dialogue over the weekend where you have Hegseth really playing up the China threat, something that China was really up in arms about, the Chinese embassy in Singapore calling out the U.S., telling them not to play with fire when it comes to Taiwan. So everything is heating up after a very brief reprieve from that trade truce.
OK, Bloomberg China correspondent Min Min Lo, thank you. We look, of course, to see whether that call actually takes place and the trade frictions that both leaders will have to walk through. That is, of course, filtering across the markets right now. US futures dropping, gold rising as those trade frictions ramp up between the two sides. Let's bring in Bloomberg's Valerie Teitel now for the market reaction. Val, that optimism then around the trade détente between the two sides evaporating as we see moves into gold and out of equities.
Yeah, that's right, Tom, especially after such a strong month for global equities. S&P 500 had an outstanding month of May, rising some 6%, but we're on the back foot in the first trading day of June. Those S&P futures down 0.5% with those losses paced in Asia. The MSCI Asia Pacific Index at one time was looking like it was going to have the worst session in over a month. Gold also rising too, so quite risk off across assets. The one asset that isn't playing ball though, Tom, is the U.S. dollar. The Bloomberg Dollar Spot Index is on a back foot. It's now posted 5 consecutive months of losses for the Bloomberg Dollar Spot Index. And there are a lot of bears out there when it comes to the outlook for the U.S. dollar. Morgan Stanley being another recent one, throwing their hat into the ring, saying they're calling for another 9% drop in the U.S. dollar in the next 12 months. That would basically double the year-to-date losses from the January highs for the Bloomberg Dollar Spot Index. So keep an eye on how the dollar pairs. It's definitely not reacting to this risk-on move and the move that it would normally rally off the back of that. Now, Treasuries as well have maybe started their posting consecutive months of losses. They fell for the first time in the month of May this year. Those 10-year yields up some 11 basis points. We also heard from Treasury Secretary Scott Bessent saying the U.S. is not going to default, and that comes as the debt ceiling standoff comes a bit closer each month.
OK, Bloomberg's Valerie Teitel, thank you very much. Indeed, that tax bill, of course, working its way through the Senate later this week, so we continue to watch that story as well. Pro-Trump nationalist, meanwhile, candidate Karol Nawrocki over in Poland has won that country's presidential election in a campaign that has laid bare the political polarisation within the country. Deeply consequential in terms of the reform story domestically, but, of course, a major player within defence of Europe and one of the fastest-growing economies, of course. Let's go straight to Warsaw, where Bloomberg's Oliver Crook joins us from the presidential palace. Ollie, talk to us about the mood on the ground on the back of this victory for Nawrocki. It was a very closely run election.
Yeah, I mean, Tom, really down to the wire. I mean, when we arrived sort of last night, within a couple hours, you had a sort of initial announcement saying that the centrist candidate had won. A couple hours later, that was then revised. And then officially this morning, it was announced that the right-wing candidate, the one that is backed by the Law and Justice right-wing party, has won the election by less than sort of 1 percentage point, really coming down to the wire. And we should say that within the Polish system, the president has a good deal of authority. He is still not Donald Tusk, who is prime minister. This is the sort of primary political actor, but he can make life life very difficult for the centrists who came into power in 2023, really vowing to reform and take back a lot of the initiatives that were put forward by the Law and Justice Party. That does not seem as if it's going to happen. The president has a large sort of vetoing authority on a number of initiatives in addition to legislation. He also nominates the central bank governor, has sort of vetoes and appraisals in terms of the ambassadors that get appointed within the country. And what you're likely going to get now going forward is much more political paralysis. That is going to make the job of Donald Tusk much more difficult, who has sort of vowed all of these reforms that he's had a great deal of trouble bringing into reality over the last 2 years, which is perhaps in part why his candidate did not win, particularly at a time that, Tom, as you highlight, Poland is playing a larger and larger role within the EU on the questions of defense. It is one of the fastest growing economies here in Europe, it's supposed to grow 3.3% this year. You see the zloty and the stock market doing very, very well. That could sort of get a little bit of hindered by what we saw in terms of the outcome, because what we're going to see is probably more political paralysis going forward.
What does that paralysis then, Ollie, mean potentially domestically for that reform agenda of the Prime Minister Tusk and more broadly for the European Union?
Yeah, what I think is really interesting is that this is not, I think it's fair to say, the outcome that Brussels really would like to see. What they would like to see at this time is a sort of moment where Europe is coming together, fully consolidated, and not having basically candidates within one of the most important economies, particularly in the context of defense, basically being very Eurosceptical. Now, this is not the sort of AfD-style sort of rhetoric. There is not sort of any discussion about withdrawing from the European Union. But in a time when you really need to have solidarity, you need to negotiate with the Trump administration, you're waging basically trade war, you would like to have all of the member states of the country fully supportive of the Brussels initiative, and that is not what this outcome in this election basically renders forward. We should also say that in another sort of strange and bizarre turn, we had Kristi Noem, the Homeland Security Secretary of Donald Trump, in Poland just a couple of days after the first result of the first round of the presidential election, basically endorsing the right-wing candidate, calling the centrist a train wreck, and basically implying that the United States would have a much closer relationship with this sort of outcome. And again, this is something that we've seen from J.D. Vance sort of weighing in on European politics. We've seen Elon Musk very active in German politics, and you see that sort of theme continuing, and you have to imagine why that is. It certainly serves the United States' interests to sort of undermine European solidarity at this critical moment of sort of diplomacy and trade.
OK, and there is the transatlantic link. Bloomberg's Oliver Crook on the ground for us in Warsaw. Ollie, thank you. Really deeply consequential story, of course, for the EU and beyond. Now, the conflict between Ukraine and Russia, and of course this ties to what is happening as well to some extent in terms of the positioning on defence around Poland and other nations. Well, that tension between Ukraine and Russia ratcheting up dramatically as the two sides set for peace talks, second round in Istanbul later today. Ukrainian drones hitting several Russian strategic airfields on Sunday, including deep in eastern Siberia, while Moscow launched one of its longest missile and drone attacks on Ukraine. For more, let's bring in Bloomberg senior editor Bill Ferries. Bill, pretty dramatic photos and images out of Russia in terms of this Ukrainian attack on some of their airfields, and as we said, deep into Russian territory. The Russian response is there as well. What do we know at this point in terms of the conflict between these two sides, and what has transpired in the last 24 hours?
Well, you saw some of the footage you were showing right there, very dramatic images out of Russia. President Zelensky saying more than 117 drones were involved in an attack that's taken more than 18 months to plan. As you mentioned, bases were struck from the Far East to the Moscow area and up north, relatively close to the border with Finland. Many of those targets, they're believed to be as many as 40 planes hit. Many of them are these long-range strategic bombers that Russia would use to carry either conventional or perhaps even nuclear weapons in a more serious conflict. Russia, of course, not sitting idly by. It's been hammering Ukraine with some of the biggest drone and air barrages of the war. So both sides really stepping up their attacks, heading into what were supposed to be talks about a potential ceasefire in Turkey, the second round of talks we've had since that first meeting about a month ago.
Well, given the backdrop then, Bill, what do we expect out of these peace talks? Are they still going ahead, and what could potentially come out of them?
Well, Ukraine says its defense minister was heading to Turkey to begin those talks, and Russia would be represented by an aide to President Putin. I think this is obviously going to overhang the whole series of meetings. Ukraine has basically said that they are still waiting, and other Ukrainian allies are waiting to see what Russia's formal demands would be to engage in a ceasefire. Ukraine, of course, has said for quite a while now it's ready for an unconditional ceasefire. Russia has not shown that it's interested in taking that step so far. The last set of talks in May resulted in some very large prisoner swaps. I would be surprised at this point, given what we saw over the last 36 hours, whether they can really find a way to go further than that.
OK, Bloomberg senior editor Bill Ferry's looking ahead to those peace talks in Istanbul between Ukraine and Russia. Thank you very much indeed. Let's bring you some breaking lines right now from Poland, where, of course, the Polish nationalist Nawrocki has won that very closely fought presidential election. The Polish premier, so Donald Tusk, of course, the Prime Minister of Poland, according to reports coming through from the Polish news agency ONET, Polish premier may ask lawmakers for a vote of confidence. ONET is Poland's online news platform. It's a Polish-language online news platform. And again, it is reporting that Donald Tusk may ask lawmakers for a vote of confidence. We'll keep across that story, of course, and bring you more details if and when we get them. Coming up, we're going to switch focus to what is happening in the oil markets. Oil gaining after a smaller than expected output hike from OPEC+. We're going to break down the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Oil prices jumping this morning after geopolitical and trade risks ramped up over the weekend, and OPEC Plus hiked production by less than some feared for the third straight month, though, and those production increases coming through in July. For more, let's bring in Bloomberg's Anthony De Paola for the details. Anthony, what was the market expecting then? Because to some extent this is a counterintuitive move in terms of oil prices higher. What did we end up getting? What was the expectation? How are investors adjusting to this?
Yeah, Tom, good morning. That's right. The market going into the meeting was expecting the level of cuts that we did get, which is just a little bit over 400,000 barrels a day. There was some speculation going into the meeting on Saturday that OPEC Plus might come in with an even bigger increase than that. So that did create some concern in terms of the outlook for oil coming in this week. If that bigger increase had been delivered, that would have potentially weighed on oil. But instead, OPEC did come in with this kind of middle of the road way to increase by about 400,000 barrels a day. That was the expectation coming in. That's actually higher than a plan that OPEC Plus had set up to unwind these cuts and to bring production back. They had initially said that they wanted to do about 100,000 barrels a day each month as they unwound these cuts. But for the last 3 months, we've had this larger increase. So that's kind of 3 months of increases in one over the last 3 months. So that's really bringing a lot of oil back to the market. And that's because OPEC sees the market in a good condition right now. We hear the same from traders as well, who say that there is demand for products. We're going into the driving season in the U.S., here in the Middle East, and in other areas around here. It's getting very hot already. So that means a lot of energy demand and oil demand for air conditioning and things like that during the summer months. So we are seeing a period of good demand. And importantly for OPEC, the stockpiles are low. We don't have a lot of oil in storage, and that's really one of the factors that OPEC Plus looks at when they judge the health of the market. Now, a word of caution, though, as we get out of the summer, a lot of people are forecasting some weakness in the market. So we are seeing forecasts for lower prices towards the end of the year as that market weakens, Tom.
OK, so those factors are there to support the market maybe in the weeks and months ahead, but longer term through the back end of this year, potentially some softness. Anthony De Paola in Dubai breaking down with expertise once again the moves from OPEC Plus and how investors are absorbing that additional barrels on the market. Coming through, of course, in July, but the decision has been made. Now to some other stories making the news today. Iran has rejected a UN nuclear watchdog report accusing it of nuclear violations, claiming the agency is motivated by politics. The report says Iran has expanded its stockpile of near weapons-grade uranium and failed to report nuclear material and activities at 3 locations. Iran says the findings are based on, quote, fabricated data, and repeated that it is not seeking atomic weapons. Several people have been injured in Boulder, Colorado, in an attack on an event being held to support Israeli hostages. Police say the weapons appear to be bottles of flammable liquid, and a suspect is in custody. Colorado's governor issued a statement condemning all hate-filled attacks. And dozens of people have been killed near 2 aid distribution stations in the Gaza Strip. Medics and witnesses say Israeli forces fired on Palestinians gathering in southern Rafah and the Netzarim corridor. Israel's military denied those claims based on what it calls its initial inquiry. Meanwhile, a US proposal for a ceasefire that would increase aid to Gaza is in limbo after Washington rejected a Hamas counter-offer. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Monday. The world's oil and gas companies face a reckoning as the energy transition develops, and headlines in recent months have signalled some are retreating from more ambitious low-carbon plans. But what about the sector as a whole? Bloomberg NEF oil analyst Claudia Lubis joins us now to discuss a complex global picture. It's always fantastic to get you on because we can cut through the headlines and get to the nitty-gritty as to what is actually happening within this sector. And certainly the headlines suggest that there is lacking enthusiasm right now around the transition, around investing in that space for these oil majors. What is actually happening on the ground? What is the data telling you in terms of the investment plans for some of these oil majors across the sector more broadly?
Thanks, Tom. Despite industry headlines signaling the wider retreat from the clean energy space, we've actually found that over 40 of the largest publicly listed oil and gas companies invested 7% more in 2024 into energy transition-related sectors at over $33 billion. And, these range from clean power generation like wind and solar, digitalization, energy storage, all the way into renewable fuels and hydrogen. And at the same time, the annual growth for these clean spend outpaced the rate at which capital expenditures for their traditional hydrocarbon businesses altogether rose. So in a way, decarbonization still remains quite a strategic theme for some in the industry. But to put it all into context, these clean spend accounted for just around 8% of the total investment made by the sector. So arguably, it's still quite a drop in the ocean.
Yeah, still a drop in the ocean, but the investment is heading in the right direction if you're looking at this in terms of the need to transition to cleaner fuels, and it kind of counters some of that headline noise that we've seen in 2024. So that's interesting. Which companies within oil and gas are kind of leading the charge on this? What are the key themes that you're seeing as some of that investment actually ticks up?
Well, 3 broad groups of companies helped lift the sector's clean investment in the past year, namely the oil supermajors, refiners, and exploration and production companies. Now, the oil supermajors, which we often refer to as the European and US big oil, so BP, Equinor, Eni, Shell, Total, alongside Chevron and Exxon, have led clean investment in 2024, accounting for around 60%. And these companies have been amongst the earliest movers and also the most persistent when it comes into the clean pivot, particularly into renewable energy. And we've seen some large deals being made, such as Equinor's $5 billion financial close for the Empire Wind Farm in New York very late last year. And some refiners and exploration and production companies also saw year-on-year gains in terms of their clean investment. And again, with some big deals, such as Woodside Energy's $2.4 billion acquisition of OCI for their low-carbon ammonia business back in September last year.
OK, so that renewable story is not dead. Far from it. That investment theme continues despite some of the headlines in 2024. And we'll see if that, of course, is sustained through this year as well. Claudia, thank you for bringing us the context, the analysis, of course. Bloomberg NEF oil team analyst Claudia Lubis with that detail. Let's check in on the futures right now. It is risk off across these equity markets on these trade tensions between Beijing and Washington. Geopolitics, of course, also at play. European futures down by 0.3% after some modest gains on Friday. US futures, S&P E-minis pointing lower by about 0.5%. Nasdaq 100 futures also lower by around 0.7. Coming up, we're going to get some more views on these markets with Charu Chanana, Chief Investment Strategist at Saxo. That is next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Tariff tensions test investors. Markets start the week in risk-off mood as China and the US accuse each other of violating last month's trade deal. Polarized Poland. A nationalist candidate backed by Donald Trump wins the Polish presidency with a margin of less than 2%. He vows to act as a check on Donald Tusk's pro-EU government. Plus, Ukraine stages a dramatic series of drone strikes across Russia, hitting targets as far away as Siberia. This ahead of crucial peace talks set to resume today. Let's check in on the markets then. Trade tensions, geopolitics, front and centre. Certainly the tension between Beijing and Washington. Will the two presidents really pick up the phone later this week? It seems increasingly tenuous that there will be that call, given the tensions between the two sides. Could, of course, materialise, but right now markets are reacting, of course, to the barbs that have been traded between Beijing and Washington on that tentative détente that was struck between the two sides last month. European futures pointing lower by 0.4%. FTSE 100 futures here in the UK currently flat. S&P futures then stateside looking to losses of 0.6%. Nasdaq 100 futures pointing down by 159 points. Chris Wallop of the Fed saying that rate cuts are still likely in the pipeline towards the end of this year. Let's check the board then in terms of cross-asset. The moves in Treasuries yields a little bit higher this morning, just around 1 basis point on the benchmark 10-year at 4.41. Euro dollar at 1.13, getting a lift again from weaker dollar. The dollar down 5 straight months through May, and Morgan Stanley suggesting that there's further 9% downside for the greenback through next year. Currently the euro up 0.2%. Brent at $64 a barrel, up 2.3% on the OPEC Plus decision to put more oil on the market, but maybe less than some investors had suggested. And copper as well. Futures stateside getting a lift, up 4%, potentially linked to the Trump tariff threat around steel and aluminium. Will tariffs also come for copper? Let's bring in Charu Chanana right now for a deeper dive on these markets. Chief Investment Strategist at Saxo, joining me from Singapore. Charu, always great to get your insights on these markets. Let's start on the trade tensions then. How should investors be positioning or readjusting to the latest headlines in terms of the tension between Beijing and Washington? Was there too much optimism baked into those Geneva talks?
Hi, Tom. Thank you for having me back. Certainly, I think this is the week is starting off on a little bit of a headline-driven volatility again, and it's not entirely unexpected, right? What we saw last week in terms of the court ruling against those tariffs from the Trump administration and the questions around the taco trade, I think those really frustrated the administration, and this was a time for them to kind of, take control of their credibility, take control of the trade war rhetoric as well. And that's exactly what has happened. Certainly means that the investors need to be agile in this environment. We are going to continue to see, that ebbs and flows as the negotiations continue. We know we are not at an end point yet, and we are actually very far away from it. So this kind of headline-driven volatility is likely to continue. But if you're a long-term investor, it certainly also demands a better look at your portfolio to understand how much of an exposure you have to the U.S. assets and whether you want to tone it down a little bit, and what are the kind of sectors and themes which are a little bit more resilient, particularly to these tariff-driven headlines.
The resilience in Europe, then, has been pronounced through May. You've seen that outperformance as the stock 600 versus the S&P 500. Many suggesting that the investment flows will continue into European equities. To what extent is there a risk that maybe, given that story that you've underlined for us in terms of the credibility of Trump's tariff regime, is there a risk that investors in European equities are underestimating the potential tariff impact from Trump when it comes to Brussels?
Certainly, when we started seeing this uptick in optimism towards European equities, this started, I think, on the back of that fiscal push that we got out of Germany and from Europe at large. And that certainly is a strong structural story, certainly undermined a little bit by these tariff threats. I think that is certainly what a short-term investor may need to keep in focus. But the longer-term story around, Europe and Germany in particular, moving away from years of fiscal prudence and fiscal conservatism, rather, towards really, boosting some of the key sectors, spending huge amounts on infrastructure, on clean energy, on defense, for example. This is a real turning point. Now, of course, it can come with hiccups, particularly if we don't see the negotiations on tariffs going in the right direction. But that does not really undermine, we've seen very strong rhetoric from, say, Lagarde, particularly around the euro, how that is changing, the outlook there is changing. So certainly, I think despite those hiccups that we might see on the back of maybe tariffs, but also more importantly, if we do see those tariffs translating into a global economic slowdown, of course, it can come down to affect the trajectory of European equities. But the structural side of the story, I think, remains very, very promising here.
How do we price in euro strength on expectations? Morgan Stanley suggesting that you get a further 9% downside in the greenback. Euro strength is being called by many out there. How does that factor into the equity story for Europe?
Of course, I think when you talk about the US dollar, I would agree, what Morgan Stanley is saying. As we continue to see this, fading of that US exceptionalism because of this prolonged uncertainty, we are yet to see that uncertainty really show up in, say, earnings or, economic numbers, hard data as well. And then that happens, you see that move away from US assets to other more, policy-driven equity markets, really in other parts, in Europe being one of them. I think we've heard, again, a strong rhetoric around the euro strength not being as detrimental to European equities, but certainly I would keep that as a watch point. Particularly European equities that are export focused will continue to face pressures as this tariff policy and the strength of euro kind of weigh down on them. And that is why I'm also looking at some of the more domestically focused European sectors, particularly in Germany, like the MDAX index, where you do see a lot more exposure to domestic stories, which will get that strength from the fiscal shift that we are seeing there, and that kind of helps you to avoid those external areas of headwinds that might come in the way.
OK, look to the MDAX, maybe the mid-cap stocks in Germany, given the outperformance of the DAX, maybe move into the MDAX for further upside when it comes to that equity story with the domestic play there. Charu Chanana, thank you very much indeed. Chief Investment Strategist at Saxo. We're going to speak, by the way, with Larry Culp, the chairman and CEO of GE Aerospace, as the aviation industry grapples with the threat of rising tariffs. That exclusive interview is next, live from IATA's annual meeting in New Delhi. Stay tuned. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the International Air Transport Association's annual gathering and general meeting and World Air Transport Summit begins today in New Delhi. The gathering in the Indian capital comes as the aviation industry grapples, of course, with the threat of Donald Trump's tariffs, potential supply chain problems and a slowdown in transatlantic travel. Bloomberg's Guy Johnson is on the ground for us, covering the event, bringing us all the big hitters in terms of interviews. Guy.
Tom, thank you very much indeed. Yes, definitely one of those standing next to me right now. Larry Culp, of course, is the CEO of GE Aerospace. It's always fantastic to catch up with him. Let's kick the conversation off. Larry, good morning. Nice to see you. Thanks for making the time. Let's talk about the conversation that is happening in the halls here in New Delhi, and that is about whether tariffs mean price rises. Is that conversation already beginning?
Well, we've been talking to customers throughout the weekend here at IATA about the U.S. trade policies. And really what we've tried to do, Guy, is just remind everybody that what we've been advocating for is a return to where we were on the heels of the 1979 Civil Aviation Agreement, which really provided tariff-free trade amongst all the signatories. That was a positive for the U.S. aerospace industry. I think that is why the U.S. enjoys a $75 billion annual trade surplus today. But we'll see how that plays out. There are a series of bilateral negotiations that are active. What we've shared with customers and with our investors is we think we've got about a $500 million residual cost challenge as a result of those tariffs. There are a whole host of things we've done with our supply chain. We're exercising the duty drawback options and the like. But we will be taking cost actions and passing along some of that residual tariff
You're
pressure.
already seeing it, aren't you? It's already starting to impact your business.
Very much so. Very much so. And that's why we're managing it as best we can, mitigating it where we can through those supply chain improvements, but also through the cost and price actions I referenced a moment ago.
And customers are saying what? They're saying you need to do it, or you need to take that cost, or we can take some of it, or kind of how does that conversation go?
Well, I think the conversation really starts back with advocacy. I think we've worked very well with our airline customers, with our airframer partners, making sure that the industry is really speaking with one voice at this point in time, because so many people, I think, believe that the prior regime really benefited the industry. In turn, we're helping make sure that everyone understands what we're doing, both operationally to mitigate, but also, again, the cost actions that we're taking to make sure that we're buffering that as best we can.
Your hope would be that you would go back to that original agreement, i.e. no tariffs on the kind of products that you make, but at the moment it looks like 10% is the minimum that the Trump administration is talking about. Is that now the base case?
Well, we're continuing to advocate in a full-throated way, Guy, for something akin to where we were with the 79 agreement through these bilaterals, right? The U.S. struck a bilateral with the U.K. Others are active. I think June will be an important month in this regard, but that's really where we are.
In terms of kind of where that takes the industry next, are we going to get a situation where we end up with quite an uneven playing field in terms of how you deal with different customers in different parts of the globe?
Well, I think it's probably too early to tell, Guy. Again, I think we want to make sure we're advocating as forcefully as we can, taking the mitigation actions, be they operational, be they cost-oriented, to the fullest extent possible, and then we'll see how things play out.
What are the big ones that you're watching for? As you say, a fluid environment, but the European Union has obviously got to be a big kind of part of this.
Very much so. Again, I think what we're looking for is to see how the negotiations play out. The July 8th date, I think, looms. So here we are in the final month. In the run-up to that, I know the U.S. government is actively engaged with multiple trading partners. Let's see how those negotiations play out.
In terms of other factors that kind of work around this, one of the other things that we're seeing as a sort of derivative of what is happening in Washington right now is a depreciating dollar. How does that affect your business? Are you already starting to see the effect of it? Is there a translation effect that we should be looking out for?
I don't think that's really a material issue for us, Guy, in large part because we transact both with our customers and our suppliers by and large in dollars. So we watch it, but it won't be a material issue for GE Aerospace.
Working forward from here, we're now thinking about how Boeing and Airbus are ramping their expectations. So you've got Kelly Ortberg looking maybe to go to 60 on his narrow body line. He just added another line. That obviously means more engines. We've also got Airbus ramping up. They're looking to get to 75. How big a challenge is that for you right now, given everything else that is going on right now? We've got issues in the engine in the engine space right now. How challenging are those kinds of levels going to be?
What a wonderful challenge to have, right? Because be it with Airbus, be it with Boeing, they are effectively sold out through the rest of this decade. We're fortunate to have the leadership position we have, both in narrow bodies, right, and in wide bodies. So we know we're going to have to do more in the back half of this year than we will do in the first half. We'll have to do more in 26 than we did in 25. But that's really, for us, the benefit of this $170 billion backlog that we enjoy. So operationally, there's a lot that we're doing, Guy, to make sure we're going in as deeply as we can into our supply chain, helping our suppliers identify bottlenecks, resolve those as quickly as we can, and build the skills and build the capacity for what's going to be required as we...
Those two factors interacting, the tariffs and what's happening in the supply chain, how much more complexity is being added, not taken away right now?
Well, it is what it is, right? I think we've long embraced the idea that we have to recognize and embrace the reality that we have, and that's the world that we're operating within. I'm encouraged just looking at what we did in April and May, for example. We saw a double-digit increase in the receipts that we get from our key pacing suppliers compared to where they were in the first quarter. So the actions that are within our control, I think, are bearing fruit. We need to sustain that and build on that over time, and that's how we'll keep pace with Airbus, with Boeing, with the airlines, and everyone else that rely on GE Aerospace.
A couple of quick questions. First one is there is a lot of concern, obviously, in Washington, D.C. at the moment, your hometown, from around the issue of the deficit. GE is a U.S. government contractor. The U.S. government is the customer. How carefully do you watch what is happening in terms of the ability of the U.S. government to continue to spend at the kind of levels that it is as the CEO of GE Aerospace?
Well, we watch it with interest, as you would imagine. Most of what we do for the U.S. government is through the Department of Defense, and we're pleased to be the supplier on 2/3 of the U.S. combat jet and rotary craft force. There's a lot that's coming as the president looks to expand the defense budget. We think that is relevant for what we do from an R&D perspective, from what we do from a next-gen, sixth-generation combat perspective. So we're very focused on those products to those customers, mindful of the macro impact, for sure.
You talk about the customers. There is a concern clearly beginning to sort of grow in Washington about technology transfer when it comes to jet engines. Do you expect, therefore, to see greater and greater restrictions into the Chinese market as a result of that?
Well, we'll see how the trade policies play out. I think that has always been front and center.
Is it just trade, or is it also national security as well?
Well, I think there is an intersection there.
Right.
But that has been the case for some time with respect to what we do. There's a rather rigorous process that we've gone through for years with the U.S. government with respect to what we're able to export. I think that continues. It might get dialed up, as your question suggests, but that doesn't bother us. We welcome the scrutiny. We're going to continue to invest in leading-edge products.
Talking of leading-edge products, we have one behind us. Are we going back to a world? So basically, just to explain, we are, up until now, jet engines have had a sort of casing around them, but we're moving away from that now. We're going to go to super high bypass engines. We're going back to propellers, basically. Is that what the next generation of aircraft is going to look like? Is it going to have these kinds of engines behind you attached to them?
Well, Guy, we're going to go forward with this sort of architecture, and you described well the open fan effort, which is a key part of our RISE technology development program. This is really technology, not a product thus far, but we think this is the architecture, as you just described, that will really rely on the propulsive efficiency more so than the thermal efficiency of the engine to bring that next step function improvement in fuel efficiency in the latter part of the 2030s. So we're excited about this. It's been a focal point in all of our customer conversations here at IATA.
Great to see you, Larry. Thanks very much indeed for making some time for us here on Bloomberg. Fantastic to see you. Larry Culp, the CEO of GE Aerospace. Thank you very much indeed. Tom, thanks for making the time. Really appreciate it. Back to you in London.
Guy Johnson on the ground for us. Great stuff. Thank you very much indeed on the innovation and the impacts, of course, of these trade tensions, live from the IATA annual meeting in New Delhi. Now, US airline, meanwhile, Delta says it is expecting travel demand to recover in the second half of the year. That's after price-sensitive passengers in the US showed spending restraint in recent months amid a worsening economic climate. CEO Ad Bastian spoke to us exclusively at IATA's AGM.
I think in the U.S. structure, lower ticket prices is part of the reason we're seeing lower prices as costs have come down. It's helping to insulate the fall off that we've seen from expectations on demand. Year over year, though, demand hasn't fallen. Demand's pretty flat to, and I expect in the second half of the year, it hopefully will tick up a bit.
Delta Airlines CEO speaking to Guy Johnson from IATA. Do not miss the remainder of our coverage from IATA through today. We've heard from Delta and Pegasus bosses. We're going to be bringing you top lines as well from the CEOs of IAG and Air France, as well as others later. So stay tuned for Guy's continuing coverage from the IATA summit, of course, in New Delhi. Now, some of the stories making the news this Monday. A new report has found that at least 10% of Britain's wealthy non-dom population have left the country. That is following tighter tax rules introduced by Prime Minister Keir Starmer's Labour government. The report was commissioned by Andrew Barclay, an entrepreneur and policy fellow at the centre-right Onward think tank. Staying with the UK, the Ministry of Defence says the government is set to reveal plans today to spend £15 billion on its warhead programme and build up to 12 new submarines. The move is intended to bolster Britain's war-fighting readiness and send a, quote, message to Moscow. And Bloomberg has learned that Samsung is nearing a deal to invest in Perplexity AI and put the startup's AI search technology into its devices. Sources have told Bloomberg Samsung is planning to announce the Perplexity integrations as early as this year, with the tech giant also expected to become one of the biggest investors in a new round of funding for Perplexity. And Stanley Fischer, a professor and practitioner of macroeconomics, has died aged 81. Known as Stan, he served as vice chairman of the Federal Reserve from 2014 to 2017, following 8 years as governor of the Bank of Israel. He's and will also be remembered for mentoring a younger generation of economic decision-makers, including Ben Bernanke, Mario Draghi and Larry Summers. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. So it's risk off across equity markets today on these trade tensions, but it's worth reflecting on the upside that came through for global stocks last month, 5.5%. That is the best monthly gain since 2023. A lot of the upside coming through for European equities as well. The DAX, in dollar terms, year to date, is up about 30%. That's year to date. And of course, in terms of the global equity story as well, if you break it down, 8 of the largest equity moves in terms of the indexes, in terms of the gains year to date, have in fact come from Europe. So that story is expected to continue. At least if you look at the analysis from the likes of UBS, they're looking at potentially $1.4 trillion of flows from US assets into European assets over the next 5 years. That is a projection from UBS. But that is the snapshot when it comes to last month's moves globally. Today, of course, risk off. Let's flip the board and have a look at the dollar, because the pressure continues in terms of the greenback. Morgan Stanley now predicting you could see further downside for the dollar of potentially 9% through to the middle of next year. You've seen the positioning as well in terms of leveraged funds, the negative net positioning on the greenback. That is pronounced as well on the day that we get that call from Morgan Stanley, around a 9% drawdown, or at least dip, and further pressure for the dollar into the middle half of next year. Let's check in on oil. The dollar, of course, factoring in terms of the oil prices. Rather counterintuitively, to some extent, OPEC Plus, the decision, of course, was there to increase output again by more than 400,000 barrels per day in July. But despite that, you've seen an increase in oil prices. Part of that is down to expectations from investors that maybe you would have seen a bigger input in terms of supplies onto the market. You didn't get that. You got the expected 411,000. Partly as well geopolitics, the attacks deep into Russian territory by Ukrainian drones. Maybe that's a factor as well. But broadly across these oil markets in the session today, you are seeing gains right now, $64 a barrel on Brent. Let's briefly check in then on the futures story amid the geopolitics, amid the trade tensions, of course, between the US and China, trading barbs around what happened in Geneva, both sides accusing the other of walking back on that commitment. European futures then pointing lower by 0.4%. US futures also softer in the session, looking lower by around 0.5%. Nasdaq 100 looking to drop around 0.7%. The opening trade will walk you through all of this. That is next. This is Bloomberg.